What's going on, everybody, and welcome to the video. In this one, we're just going to be talking a lot about how to make your dividend portfolio grow at its fastest rate possible, how to make it the most effective, how to live off dividends in the fastest sense possible, and the power of the dividend snowball effect, giving you kind of tips and just some illustrations and a ton of different things that are very useful. But if you do enjoy this type of content, all I ask is that you subscribe to the channel and you turn on post notifications so you don't miss out on any of my future content. But let's go ahead and get straight into the video. So as we're looking at, this is my portfolio sitting at $12,450 right now over the past week, up about 1.5%. But looking a little bit deeper into my portfolio, if you do want access to these spreadsheets, I have a ton of spreadsheets you can use that are very good for just your dividend portfolio, stock valuations, things like that. Check out the link in the description down below to my Patreon. But this is kind of how my portfolio has been doing pretty poorly overall. Markets have been down, especially recently with the SVB and the ton of financial sector just not doing too well. As we see my sector diversification, a lot of it isn't financial, but a good chunk of this financials is ETFs. But let's go ahead and kind of talk about what we're in this video for. So first up, we're just going to be looking at how to get this information and how to kind of track your dividend stocks. First up, check out Seeking Alpha using the link in the description down below. You can kind of just get all this information if you do pay the kind of premium prescription. You can get good information on their dividend ratings, things like that, which gives you an edge on how to know which dividend stocks are safe, which dividend ones grow the fastest, how long they've been growing, things like that. And it gives you just ratings, which is just a very useful tool when it comes to valuing your dividend stocks and creating a portfolio that actually is going to make good returns. Now let's go ahead and talk about the dividend snowball effect. So if you don't know what that is, it's very simply defined, okay? Each time a company pays you a dividend, what you do is you automatically reinvest that dividend and you buy more of the stock. Keep continuing to take these dividends and put them more to the stock, whatever investment it is. That means you own more of that stock. So the next time they pay that dividend, you will get paid more. And then once you get paid more, you put it back in and it just creates a snowball effect that compounds. So I'll show you a little bit of a visual of how this works because it makes a massive difference in your portfolio over the long term. So we're going to be going over two different investment times. One time is they're both 25-year time horizons. One is an investment of $1,000 and one is going to be investing $1,000 every month. Assuming just kind of a historical observation of 3M, the stock triple M, all their dividend percentages, dividend growth rate, which is 10.99%, and the growth rate of the stock is about 7.5% with all of these different things. Let's go ahead and kind of just look at these numbers. With a one-time investment of $1,000, when you reinvest your dividends, you will have $23,789. And when you don't reinvest those dividends, you will have $6,442. So here's just kind of where it goes. Your total cost, even without reinvesting the dividend, you still make some good returns over the 25 years to $6,442. But with reinvesting those dividends, which is, you can passively do this, this shows you the massive effect. It's almost a 4 times difference in your portfolio just by reinvesting dividends. But it gets even crazier when you do consistent investments of $1,000 every month, okay? This is what happens. Same situation, 25 years. Only difference is one portfolio reinvested dividends, one portfolio doesn't. When you reinvest the dividends, you are ended with $2.3 million. When you don't, you're ended with $877,000. Now, these are just two hypothetical scenarios, but it does show the overall effect of how effective reinvested dividends are. So how to kind of do this? Very simple. You just kind of choose some dividend growth stocks, dividend stocks, high yield, whatever it is that your portfolio you want in your portfolio. You could do ETFs even. Pick those, buy them, okay? Step two, continuously add money into your portfolio and continue to invest. 3, all dividends that you receive, they need to be reinvested. Then just be patient. I will say this is not a get-rich-quick scheme by any means. It does take a lot of time. And then you just have to be patient and continue this process until you reach your dividend crossover point. And just showing you a little bit more of the power of compounding. And this is a very hypothetical situation, almost unrealistic. But if you had $1 that compounded 1% per day, in just 5 years, you would have over $77 million. By year 7, you would have $109 billion. Now, this is just to show you the power of compounding. It's not like you're adding new money. It's just new money being kind of created with your money, and that new money that you've created is making more money over and over and over again. And just to show you kind of how effective this is in the real markets, here's an example of Coca-Cola. Just the returns you can get mixed in with compounding is insane. So ever since about 1960, I want to say the time was, for Coca-Cola, total return price, 7.81 thousand percent change. And this was a while ago, it's about in 2019, so keep that in mind. And then with its dividend percent, 2.36% thousand percent change. That's a 2.36% thousand percent growth, okay? That is huge. That is massive. So keep that in mind. But I kind of want to talk to you a little bit about my perspective and my tips and tricks on how to get to this perspective. Now, I kind of just want to talk about the fastest way to necessarily live off of dividends. First up, like I said, find some stocks and ETFs that have really good dividend yields, solid future outlook into their future of their business, because you don't want to be buying stocks that you think are good, but in reality, they're about to just do terrible, okay? To get this, you want to look at low payout ratios, which is a very, very important thing. Second off, do not fall into the yield trap, because a lot of stocks per se might have a 15% dividend yield, but they're falling 25% in value. You need to make sure that share price appreciation is coming in as well, that they need to be financially sound, have a lot of assets, not a ton of liabilities and things like that. Keep that in mind. That is very, very important. Third, make sure the securities you're purchasing are consistently paying these dividends and increasing their payments per se annually, just because it helps your dividend snowball effect be even more effective and come into play faster. If you're not getting paid consistently, it's obviously not good. And if you're not getting increases in your payments, you're losing on extra returns that you could be getting somewhere else. Fourth, stay consistent by adding money into your portfolio on a consistent basis, okay? I know you can reinvest dividends and you can get that money to be paid, but if you can continually add money, it's just going to make your dividend snowball effect come into play way faster. Most brokers, you can do the drip setting where it automatically reinvests once that dividend is paid. But what I like to do is to let these dividends sit in my portfolio, and then on a red day or a red week, something like that, I will put that money into the portfolio at that point in time. Fifth, find an extra stream of income to further support your portfolio to grow faster. Maybe a side hustle like freelancing, Uber Eats, even a part-time job, whatever it is. If you are serious about this, you need to be doing that. And then lastly, dividend reinvestment plan. Like I said, arguably the most important piece of the puzzle. Reinvest your dividends. It is so, so important that you do this, because all dividends that your portfolio makes must be reinvested back into the portfolio. That is what causes the dividend snowball effect to come into play by any means, and it just enhances your dividend income to absurdly extreme amounts. Next up, some of my favorite dividend stocks to give you a little bit of insight. I'm not saying to go buy these, just some kind of perspective on this. So some higher yield stocks can be XYLD, QYLD, SPHD, SCHD, and SPYD. These are actually all ETFs. And then some lower yield but faster growth would be ticker AVGO, MSFT, AAPL, LOW, and MS. Just some of my favorite stocks per se, but this is not me telling you to go buy these stocks by any means. And then I want to show you another comparison of drip versus non-drip. Both of these are portfolios with the exact same criteria. $5,000 initial deposit, $500 a month deposits, 3% initial dividend yield, 6% expected dividend increases per year, and 8% expected annual share price increases per year. This is also over a 40-year investment time horizon. Here's what we get. Okay, remember, this is with no drip. At the end of the 40 years, you will have a portfolio balance of about $1.66 million. Very good. Now, what about a portfolio with drip? The exact same. You're going to have a portfolio with about $2.65 million. That's a $1 million difference. This just shows you the effect, the total difference. And then when you also just kind of look at the average returns and things like that, your total return without drip is 578%. With drip, it's 984%. Your yield on cost without drip is 9.35%. With drip, it's 14.79%. These are some very big things to keep in mind. I also want to show you a little bit more so that you understand the power of this and how important it is to do this in a very smart way. So first off, if you do want to kind of go use this dividend calculator, just go to marketbeat.com, look up their dividend calculator. It's very easy to find. It's 100% free. You can type in all your information, things like that, and get your kind of expected numbers. So I just want to give you that information. But lastly, like I said, you don't want to just be buying ETFs. Like I said, I really like QYLD. It's something I like. They have a really good dividend yield. I want to say their dividend yield right now is like 11%, something like that. Okay, for yielding 14.3%, but that's a 14.3% yield over the year. Over the past year, it's down 18%. So this is what I'm talking about. These high yields are often very dangerous. So make sure that you are being smart with this, okay? You don't want to go in, just buy the highest yielding stock. You need to be very smart, because if that's what you're doing, in reality, you're just putting money to waste. So be smart with your investments. That's what I want to say. But everybody, thank you for making it to the end of this video. If you did enjoy it, make sure to subscribe, turn on post notifications so you don't miss out on any of my future content. Check out the links in the description down below, such as my Patreon, and get access to my spreadsheets, or M1 Finance, get some free money in that portfolio. And I will see you in the next video.